HECM. What the heck is a HECM? No one knows what a HECM is, which is a good thing because it gives your borrowers the opportunity to ask the question, well, what's a HECM? It's a home equity conversion mortgage. If you take the word home equity, right, we know what that means. Conversion, we're going to convert the home equity, and ultimately it's a mortgage. This is not a grant. It's not free money. It's a mortgage. It's a mortgage like any other mortgage. And we all know how mortgages work. So a person borrows money from a bank. Typically, it's 30 years. They make monthly payments for those 30 years. But the day they close on their loan, on their home sale, on the home purchase, they now own the house. Even if they did a VA loan and they financed 100% and there's no equity, they still own it. And as owner of the property, they pay property taxes, homeowners insurance, they maintain it. If they close a loan today, a home purchase today, and tomorrow someone offers them $20,000 more than they paid for the home, and they sell it, they just made $20,000, not the bank. What's interesting, when I ask that question to many people, including real estate professionals, if you have no equity in your home, you borrowed money from a bank, 100%, and you have no equity, who owns the house? Many people say the bank does. It's not true. Look at the title. Look at the property appraiser's website. It'll say Joe Smith owns the house, and Bank of America has a lien against it. Right? So a mortgage is a mortgage is a mortgage, whether it's a traditional loan, a VA loan, an FHA loan, a HECM, they're all mortgages. And they all have basically the same terms. You borrow money from a bank, the bank puts a lien against the house, you own the house, and you also owe the bank money. So let's go way back. I'm not going to bore you with the facts of history, but I think it's interesting. So there's various types of reverse mortgages that have been available for the last 60 years. The very first reverse mortgage was written in 1961 by a savings and loan up in Maine. And the story goes, a little old lady went to her bank and said, my husband just died and I can't live on my Social Security alone. And I have this house that's paid for. Would you buy the house from me but let me live there for the rest of my life? And the banker, small town, the banker said, well, let me see what I can do. And when the deal was done, Nellie Young sold her house to the bank. She continued to live there for the rest of her life. And when she died, the bank got the house. But she got money for the house while she's alive to survive. And that was the very first reverse mortgage ever written. Now, perhaps that's where the negativity starts from. Most of us, if not all of us, have heard the fact that if you do a reverse mortgage, the bank's going to own the house. If you do a reverse mortgage, you give up your rights. If you do a reverse mortgage, it's the loan of last resort. And that's one thing that when FHA stepped in back in the 80s, they eliminated that. This is just a mortgage. Home equity conversion mortgage is just a mortgage. The person who does these kind of loans is still going to be on title to the house. They're still going to own the house. They can still will it to their family. They can still sell it in their lifetime. The only difference between a HECM and a traditional mortgage is that traditional mortgages have mandatory monthly mortgage payments, where a HECM has optional monthly mortgage payments. Yes, a lot of people say no mortgage payments. No means no, but this is just a mortgage, like any other mortgage, which means that if a person wants to make a mortgage payment, the bank will take the money and will pay down the balance. So when someone says, well, I'd never do something like this, well, why not? Well, that's where the bank takes the house. Well, why do you say that? Because that's what all my friends tell me. It tells you right there they don't understand the program. So over the next 2 hours, hour and 45 minutes, everyone here is going to learn a lot about this program, and you're going to go from either you dislike this program to you're not sure if you like it, to you like it. You're going to go all the way to the love word. You're going to love this program by the time we're done. Any questions yet? All right, I'm expecting questions from everyone, so start thinking about them. So way back in 1969, there was congressional hearings on this whole program that happened up in Maine, Nellie Young. And Congress, both the Senate and the House, loved the concept of some kind of a housing annuity. There was a lot of interest in it. This is a way for retirees to supplement their Social Security without losing their house. In fact, let me maximize this. Here we go. That makes it easier to read. So the first congressional hearing took place of this back in 1983. Senator John Hines really came to bat for this, and they had this American Homestead Program, the foundation, and they wanted to have the government insure these programs. They called it the Century Plan. By 1987, Congress passes the FHA insurance bill called the Home Equity Conversion Mortgage. They did the HECM program, which is a reverse mortgage pilot program. And no one knows what a HECM is, so the word reverse mortgage sort of stuck. 1988, Ronald Reagan signed it into law. The first HECM refinance was done in 1989. So think about that. 36 years ago, the very first refinance HECM, home equity conversion mortgage, was closed in this country. Now, it wasn't until 2009, 2010, during the housing crisis, that FHA decided to allow the HECM for home purchase. So before, you had to already own a house, refinance it, and now you can actually purchase a home with a HECM reverse mortgage. So this presentation is mostly about the HECM for home purchase. We are going to touch base on the HECM refinance because I think that comes into play. Sometimes you meet a client that selling and moving is not in their best interest, but they need to have some kind of money extraction from their home. So the refinance comes into place. And you as real estate professionals are running into those things firsthand. People that can't sell, won't sell, change their mind about selling, and maybe the refinance program is going to fit their needs better. So let's talk about the reverse mortgage. And this is where I'm hoping to convince everyone to get the word reverse out of your language. And I like to use the dog and sometimes fruit as an example. We have a small dog, like a lap dog, a Shih Tzu. And most of them are nice, not always. Then you have Great Danes and Doberman Pinschers, Rottweilers, German Shepherds. And those could be considered, maybe not a Great Dane, because I've had several of them and they're such lovable dogs, but some dogs are considered aggressive. Some dogs are pack dogs. But not all dogs are the same, right? A poodle is different than a German Shepherd. So, but they're both dogs. If you were in the breeding business and you were selling poodles, you would probably advertise it as poodles. The good dog, the sweet dog, the lap dog. You wouldn't advertise a poodle to be a guard dog necessarily, and you wouldn't advertise a Rottweiler to be a lap dog necessarily, but they're both dogs. And we can do the same thing about fruit. Strawberries are sweet, lemons and lime are sour, but they're both fruit. So my point is let's call a HECM a HECM. Yes, it's a reverse mortgage. Yes, it's a type of reverse mortgage, but reverse mortgage is a slang term, no different than fruit. A lot of fruits. No different than dogs. Lots of dogs. Reverse mortgages, there's different varieties, different types. There's private. There's the FHA version. They're all reverse mortgages. But let's call a HECM a HECM. A, no one knows what a HECM is. B, it gives you the opportunity to explain the program or at least refer the explanation of the program to a professional. That really can get down and dirty, the good, the bad, and the ugly of what the heck a HECM is. Because if someone poo-poos the whole idea even before you're able to present it to them, then they're not listening. If they're not listening, you as a real estate agent may not have an enhanced sale, which we're going to go over in a little bit. All right, keep thinking of questions because I need some. So let's talk about 2008, 9, and 2010. Let's talk about when FHA decided to help boost the recession, the Great Recession, by introducing something that we've been asking for many years, is the HECM for home purchase. This allows real estate agents to sell homes. So think about this. If a person wants to refinance a house, they have to already own the house. And whether it's paid for or not is not necessary. It doesn't have to be paid for, is my point. But if a person owns a house and they want to pull out money from that house, then they're doing a refinance. If a person doesn't own a house, then they've got to put money into the house, such as a down payment. So let me give you a story that will help sort of digest that, because this is almost like a reverse of a reverse. It's the most amazing thing. A reverse of a word. If that doesn't make your head spin, what will, right? So let me tell you this story here.
So,
Two identical twin sisters. One lives in Florida and one lives in another state. But they're identical
okay.
twins. They're identical in every
They,
way. They just happen to live in two different states. The sister who lives in Florida owns a $500,000 house that's completely paid for. And, and depending on her age, she's able to pull out a certain amount of money. The older a person is, the more they can pull out. So let's just say that based on her age, she's able to pull out $200,000 of her home, of her home's value. All right, so focus on this. Senior citizen over the age 62. She has a $500,000 house that's completely paid for. And if you want to write this down, feel free to. Based on her age, she's able to pull out $200,000. So now she's sitting at her kitchen table. She's got $200,000 in a pile of money on her kitchen table. She now owes the bank $200,000, right? Because she borrowed it. She's got $200,000 on her kitchen table, and she still has $300,000 worth of equity in her house. That's worth $500,000. All right, we're all good with that. We're all in the real estate business, so that should be easy to understand. Her identical
I
twin
have,
sister just sold her house in the other state, comes to visit her sister and says, "Wow, where'd all this money come from?" She says, "I just did a reverse mortgage. And this $200,000 is tax-free money. I can do anything I want to with it, but I don't know what I'm going to do with it. Maybe I'll buy my fancy Cadillac. Maybe I'll take a vacation. Maybe I'll put a new roof on my house. Maybe I'll do this and that." And the sister says, "I miss you so much. I wish I lived here. I love your house. It's perfect." And Florida sister says, "Well, house next door is for sale." She's, "Oh my gosh, I'd love to buy it." "And how much money do you have?" It's $500,000. And the sister says, "Well, I have $500,000. I just sold my house." But then the sister starts to think, "I don't want to spend all my money. I need this for retirement. Maybe I'll just rent." And the sister says, "You could do a HECM for home purchase. Since we're the same age, and since both houses are $500,000, you could put $300,000 down, keep $200,000 just like I have, and now you own a $500,000 house. You're going to pay the property taxes, the homeowner's insurance, the HOA. You're going to owe the bank $200,000 because that's what you're going to borrow, but you have $300,000 of equity because that's what you use as your down payment. And now both sisters have the exact same house with the exact same mortgage, owe the exact same amount of money. One pulled out $200,000 and one put in $300,000, but they both have the same loan. And that's what we're going to talk about today.
I have a
Question, go
question.
ahead, Layla.
So if that's what she does, is she going to pay interest on the $200,000 she's going to take?
Good question. So this is a no required monthly mortgage payment program offered by FHA. So the $200,000 is going to accrue interest. However, no payments are required, which means the 6.5%, approximately what interest rates are right now, the 6.5% interest that she's being charged every year on the $200,000 that she borrowed is going to be deferred. So next year she won't owe 200,000, she'll owe 213,000. So when she gets her monthly statement, it'll say this is not a bill. It'll say the interest for this month is $1,100. She can just say, "I'm not going to pay it." And by not paying it, then she's going to owe more next month. But also keep in mind that the value of the house will also increase in value. That answer your question, Layla?
Yeah, but that mean does the interest like has penalty on it or any of that on top of the interest because she's not paying it?
Right. If she doesn't pay it, then she's going to owe more next month, and then interest will continue to accrue for as long as she doesn't make that mortgage payment.
But there's no penalty.
The idea is, and Catherine, I'm going to get you next. The idea behind this HECM is that it creates cash flow for senior citizens. If by her not having to make $1,000 a month mortgage payment is going to keep $1,000 a month in her bank account so she can enjoy retirement life. Upon her passing, she's not taking the house with her, right? No one's taking anything with you. So how much the debt accrues almost doesn't matter if you can have a better retirement life. Now, the good news is that she doesn't want to have that debt accrue. She can make a mortgage payment, and she can make $100 a month. She can make $500 a month mortgage payment. She can make $1,000 a month mortgage payment, or she can just skip it all together. Remember this: homes increase on average across the nation. In Florida, homes increase by 6 or 7% a year.
Yep.
Across the nation, it's 4%. So 4% on $500,000 house is 20 grand. Per house is supposed to go up by $20,000 a year, just based on historical math going back 100 years of housing data. If her house increases at $20,000 a year in additional equity, and her interest accrues at 13,000, then even
You're
though it's a
making,
rising debt loan, it's a faster rising asset. She'll have more equity in the future than she does even today by having a more expensive house. Is that good, Layla?
Yeah, but I have more questions, but I'll wait.
All right, let's take Catherine, then we'll come back. Go ahead, Catherine.
is the minimum age for a mortgage 62 years old in order to qualify for this?
Okay, that's a great question. The good news is that FHA's minimum age for the borrower, that's a key word, is 62. The spouse of that borrower can be any age, all the way
Any,
down to age 18. Now there's later on in these slides, we're going to talk about the proprietary or portfolio HECMs. Those ages start at 55. Now, the portfolio reverse mortgages or HECMs are not FHA, they're not insured by FHA. They have a different set of rules, but that's usually easier to qualify for. So the portfolio HECMs start at age 55, but both spouses must be 55 or over. Where the FHA HECM, the age starts at 62, and the spouse can be all the way down to age 18. But they have to be married, legally married. It could be a same-sex couple, but they have to be legally married for the spouse to be considered, as long as they're an adult, age 18, then they can both be part of the deal. I'm really glad you brought that up because I may not have brought it up later on, so that's good. All right, Layla, do you want to ask another question?
Not now.
Okay. All right, let's move on to this. So reverse mortgages in general terms, and there's a lot of types of reverse mortgages out there. It's a type of loan that has no required monthly mortgage payments. And the reason I say that is because there's the FHA version, there's the portfolio type, and then there's the county. The counties, at least every county in the state of Florida has its own type of reverse mortgage. So the three types that FTC recognizes, the Federal Trade Commission recognizes, is the FHA HECM, which is by far the best and the safest. Single purpose, which is like a property tax deferral. Orange County, Seminole County, my gosh, my mind just went blank on the other counties. And I live in Orlando, so Orange County comes first. But anyways, your county, if somebody that meets the county's guidelines, I know in Orange County you have to be 70 years old. Your house has to be worth no more than 250,000, and they may have raised it since homes are now 400,000 and up. And you have to have a limit of income. The county will defer your property taxes for the rest of your life if you meet certain criteria. So if that's is something that you'd like to learn more about, just contact your property assessor's office, property appraiser's office, and ask them what their single purpose reverse mortgage or single purpose tax deferral program, what the rules are for seniors. And then the proprietary, I like to call them portfolio because it sounds better, but there's the same name that you can switch around. Those are private programs. They could be private, meaning that it's an individual, that an investment company, or it could be that it's a bank, but it just means that it's not federal government insured. They're usually backed by state governments. There's usually some protections built in. They're usually cheaper to get into, but the interest rates are usually higher. And each one of these programs has their pros and cons. If they didn't, they wouldn't be around. And I like all of them. I like all three of them. So a HECM is a type of reverse mortgage, not the only reverse mortgage. The HECM happens to be, the FHA HECM happens to be the best and the safest. It's sponsored by HUD. It's insured by FHA. The HECM has a fantastic reputation satisfaction rate. In fact, AARP did a study a few years back and said that everyone that has ever closed on a HECM, and by the way, there's been more than 1 million families that have closed on the HECM over the last 36 years. It's probably 1.2 million over the last 36 years. They have a 96% satisfaction rate. So remember this, the HECM, the FHA HECM or any kind of HECM, even the portfolio HECMs, have no required monthly mortgage payments. And the key word here is required. It's not required. I don't like to use the word no monthly mortgage payments because no means no. And when you're not allowed to do something, then it's no. And I want to eliminate that because, Layla's comment was perfect, or her question was perfect. Well, if I don't make a payment, then my balance is going to go up. Well, and that scares me. I made that part up. Well, that scares me because eventually I might owe more than I would ever think I would owe. And my answer to that is, well, then make a mortgage payment. Just because you're not required to doesn't mean you can't. So that handles that objection. And second of all, is the property should be increasing in value a heck of a lot faster than what's owed. And the third thing is FHA doesn't loan 100% of the value. So I used the example before, the twin sisters. They have a $500,000 house. Based on their age, FHA is going to come up with a number. And I used the 200,000, which is about 35% of the home's value. That's about what FHA is willing to lend. FHA doesn't want to be in the position of owning houses. They just want to help people get mortgages. So that they won't loan 500,000, they won't loan 300,000, they won't loan 400,000. They'll loan a portion based on a person's age. The older a person is, the more they can borrow. So if these two sisters were 85 years old, they might be able to borrow almost $300,000 with the idea that even with the compounding of interest, they're never going to owe more than the value of the house, unless, of course, we have a housing recession and homes go down in value. But there's also some guarantees on that. All right, Catherine?
So can this be done for any type of a housing, like, because in Florida, we have a lot, many, many, many. There's mobile home parks, there's all these. Do you have to own the land and be able to obtain a regular mortgage? Or can you do something, can you do this if you have like a leased land situation?
It's one of my favorite questions. I like to answer things very simply. The quick answer is we can do a HECM on every property. That's the quick answer. Now, to define that, FHA has certain rules. FHA will not do an FHA HECM on a condo unless unless the FHA condo, or unless the condo is FHA approved. And that's hard because very few condos are FHA approved. And that's where the portfolio loans come in. Portfolio loans have a little higher interest rate, but have lower closing costs, and they will do condos all day long. And they don't have to be FHA approved. And it's no different than a regular mortgage where you have to go in with your condo questionnaire and have it completed. Well, the portfolio loans do the same thing. There's a condo questionnaire. We have to verify they have the proper insurance, that most of the owners there's a certain amount of owners as far as rather than renters. There has to be money in reserves, your typical stuff that with regular financing. So yes, we can do leased land, we can do manufactured homes, we can do cluster homes, we can do zero lot line homes, we can do townhomes, single family duplexes, triplexes, quadplexes. We can do all that. If FHA won't do it, then a portfolio loan will do it. So there's very few that the answer is no. Leased land, there's some additional questions. They want to make sure that the lease isn't an annual lease, meaning that it's not renewable at the end of the year. Is it automatically renewed every year until the person is done with the property? Or is there a 100-year lease? And there's some leases that aren't worded properly and no one will do loans on them. And usually that's the same with traditional financing. If you know from your experience as a real estate agent, a broker, that you can't do loans in this particular manufactured home park, it's all cash deal or you're not buying, that's because they don't have the property set up properly to be a lending friendly environment. So here's the thing about these HECMs. This is not a VA loan where they're going to do 100% financing on a purchase. It's not an FHA loan in the sense that a person can put 3.5% down or 5% down. This is a loan. The HECM for home purchase is a program where a person would normally pay cash for a property, and they either don't want to give up all their cash, but they don't want a mortgage payment in retirement either. So FHA came out with this program with, okay, maybe the house that you want to buy costs more than the cash that you have available. Or maybe the house that you want to buy is going to take all your cash and you don't want to use up all your cash in retirement. Cash is king in retirement. Fair enough? Cash and cash flow is king in retirement. The problem with paying all cash for a property is that, the problem with not paying all cash for a property is that you have a monthly mortgage payment. And most loans are 30 years. Who at age 70 wants to move into a house with 30 years worth of mortgage payments? And maybe at age 70, maybe husband and wife just retired. They have a nice pension. They have nice Social Security. Credit score is high. Life is grand. But what's going to happen over the next 30 years? Almost for sure, one of them will pass away. Less income. Almost for sure, one of the two will wind up with some kind of long-term care needs, home health care, some health issues, rehab. Almost for sure, they're going to have to replace the roof, replace the HVAC,
تحلل
do
الباب.
some home repairs. I'm sorry, question? Okay. So just because life is grand, no one wants a required mortgage payment for the rest of their life. So this gives them the option of not having to make a mortgage payment. Here's the other beautiful thing about this program is if person does, Layla, I put you on mute just for a second. You can always unmute yourself. But here's the beautiful thing, at least with the FHA HECM. Anybody who decides to make a mortgage payment, the money is refundable at no charge. They set up a line of credit. If a person decides, I don't like this monthly, they get a statement every month. And people will see that the balance is going up. And some people don't care, and others like, oh no, that's high. Oh my gosh, $1,000 a month worth of interest is just piling on. Well, it could be $1,000 out of your checkbook every month, or $1,000 on a piece of paper that says you owe more later. And if you die in the house, you don't ever going to have to pay it back because it's not your problem, right? Just to put it bluntly. Some people want to make payments, but when FHA designed this program, they allow people that anytime they make a mortgage payment, if they change their mind anytime in the future, they can ask for their money back, all of it, plus a 7% growth factor, which we'll go over later. They get all their money back. Now, you can't do that with a regular mortgage. Once I make a mortgage payment, I have a mortgage. Once I make a mortgage payment, that money's gone, right? It goes to pay down the balance. I build my equity, but I can't get it back. With the FHA HECM, it's fully refundable at no charge. Now, I've said this before, but let me just repeat it because I like to repeat things. Your client is the homeowner. And as a homeowner, they've got to pay property taxes, homeowners insurance, HOA dues, and they have to maintain the house because it's their property. And that's normal. They're a homeowner. So remember this, the HECM for home purchase have all HECM for home purchases have no required monthly mortgage payments. The FHA, whether it be the FHA or the portfolio proprietary type, the basic details are the same. So we're going to be going back and forth a little bit, but this whole presentation is about the FHA HECM for home purchase. We're going to talk about refis, but this whole presentation is mostly the FHA HECM for home purchase. So I mentioned before that the approximate down payment is 65%. But I also mentioned before that the younger a person is, or an older a person is, the down payment varies. So a young person, let's say age 62, may put down 70%, 68%, or an 80-year-old might put down 60%. So the older a person is, the less the down payment. And the reason is because it's less life expectancy. Now, here's another way of saying what I just said. Putting 65% down on a property when you were going to pay cash for it, or putting less than all cash down just to save cash for retirement makes a ton of sense. But let's change the wording because it's the same math. If someone comes to you and says, I have $300,000 in cash, sell me a home. Now, here's a serious question. I want you to dig up to your brain real quick. If someone comes to you and says, I have $300,000 cash, what is the first thing that hits your brain? That you can't buy a house in my area for $300,000. Is that fair? Because they tell you they want a pool, they want a 55 plus community, they want to be close to shopping, they want to have all the activities in that community, and you're thinking, yeah, right. Well, let me get you pre-approved with the VA loan officer. Let me get you pre-approved for conventional financing. And they say, well, no, I don't want a mortgage payment in retirement. So what do? They become renters, or do you move them over into an area that they're not even happy with? But then you remember that you invested 2 hours of your time into this class, and now that 300,000 turns into a $450,000 purchase. Now my question to everybody is, can you sell them a $450,000 home, something that they'll be happy with no required monthly mortgage payments? And the crowd goes wild. Yes, we can find something. If they had $400,000 cash, there's a $200,000 boost. That's a 50% boost. If someone comes to you and says, I've got $400,000, quick math in your head is I can get them a 50% boost in their purchasing power. I can get them a $600,000 home with no required mortgage payments. 600,000 gets them $900,000 home. $800,000 gets them a $1.2 million home. Now, here's the question of the day. If you sold them a $600,000 home, you would make X number of dollars commission. If you sold them a $900,000 home, is that a larger commission? Again,
Yes.
yes.
Yeah.
And
Hey, Tim, I got a
that's where,
question for you.
I think so.
Carmelo,
I think one of the attractive things for folks about HECMs or reverse mortgages is the ability to have cash when they close. In one of these scenarios, will the person be able to walk away from the closing table with cash and the new home and the option not to have to make monthly payments?
well, the option of not having a monthly mortgage payment is written in stone. Yes, that's an easy one. There's
No, yeah,
never a
that's
required.
yeah,
Right,
that's a given. So that's one of the
right.
incentives for it.
So
But
the cash,
the
go ahead.
the question is, in one of these scenarios, is someone able to walk away with cash after closing, in addition to closing on getting the home?
Okay, if I understand your question, I'm gonna say no. It depends on what they start with. If someone came to you and said, I've got $300,000 cash money,
We should have
and
said,
then you
I said, okay, I go text it to him.
Wow.
Don, you got to mute, please.
all right, he's on mute. So if someone went to the real estate agent and said, I've got $300,000 cash, and in your mind you're thinking, okay, I'm going to sell a $450,000 house, but you wind up going to a $400,000 neighborhood and they close on a $400,000 house. The down payment on that may have been $275,000.
Okay.
So in that scenario, they would have $25,000 left over, putting $275 down, which is the 300, and they're buying a $400,000 home. If all the cash they had in the world was $300,000 and you bought a $450,000 home, there's no money coming from the HECM
Okay.
on a monthly basis or lump sum. There's no line of credit. You've used every dime to acquire the home.
Understood. Okay.
And I get that question several times where someone says, okay, well, reverse mortgage, HECM is where the government pays you a monthly stipend. Well, in this case, there is no monthly stipend because we're using every dollar that's available to purchase the house. So when
Right.
we're
So
done, the loan, in a sense, is closed. There's no line of credit. There's no money exchanging hands because every dime was given to the seller in order to secure the house.
so
Now,
it would
on a
be up to the.
refinance,
Go ahead. I'm
ahead.
sorry. No,
I
after
was
you,
going to say
please.
on a refinance, if someone has a $450,000 home, based on their age, they might be able to pull out 150,000. If they don't want that 150,000, this is a refinance now. They have a
Right.
couple of options. They could take monthly installments, just like Social Security. They could set up a line of credit and just get it later. Could take a lump sum at closing, or they can mix and match those four things. But
Right.
that's for a refinance. For a HECM, typically we're using every dime to make the transaction work, so we can give the seller their $450,000 purchase price or selling price.
Property. Right. But
Property.
if somebody has 300,000 in cash, an incentive for them to get a HECM might be to buy the $300,000 house, but only put down 200,000, and then they'd
Yep.
have either the monthly income or they'd have the 100,000 in cash.
Right. That's a
Okay.
good point. Good point, because that's the beautiful thing about this. If someone did want a $300,000 home, that's what they want, and they had $300,000 cash, they have two choices. They could buy the home with all cash and have no money left, or they could use the HECM, put $200,000 down, keep $100,000. So the answer is yes in this case,
Right,
and
because
and
what you
that's what's
said
powerful.
earlier is, I'm sorry, what you said earlier for the realtor's incentive is to make more commission, but
Right.
realtors want to sell homes. So if they can have
Right.
somebody close on a $300,000 home, if they have 300,000 in cash, and they'll make a little bit less
Right.
commission in the $450,000 home, but the homeowner will be in a better position,
Correct. Well said.
financially speaking.
So one of my very last slides, and one of my very last slides in this presentation is always do what's best for the customer. If the customer comes to you and says, "I found the house that I want. It's $300,000. I've got the cash money. I want to buy this house." Real estate agents just want to take that cash, have a closing next week, and call it a done deal. And the last thing that common sense would say, you don't want to gum up the works by doing an FHA loan right in the middle of a cash deal. But what's best for the customer? If you're able to get the customer into the same house with an FHA HECM and they save $100,000 for retirement, you just made their financial life a heck of a lot better. When they realize they've got $100,000 to enjoy life in retirement, they're going to tell two friends, and they're going to tell two friends, and so on. That goes back to the whole referral question. I always say, do what's best for your customer first, and everything else will take care of itself. All right, we have 5 minutes before a break. So the primary differences between the two HECMs for home purchase is the FHA starts at age 62 and the portfolio HECMs start at age 55. And spouses, once again, for the FHA can be down to age 18, where the portfolio HECMs, both spouses have to be at least 55.
Question, Tim, are the portfolio HECMs backed by the government as well, or only the ones at 62?
They're backed by the state in a quasi way. The federal government fully backs it up with a trust fund that has hundreds of billions of dollars in it, and that trust fund is funded by people that take out the FHA HECM. With portfolio loans, they're run through the state. The states have to approve the product and the lender, and the state doesn't necessarily have the dollars to back it up, but they do their due diligence to make sure that the investment company, typically Wall Street types, have enough money that if the house were to go down in value, that the investor is not going to go belly up and not honor the contract. The nice thing about the portfolio loans is there is no FHA insurance fee, which is pretty steep. It gets financed into the loan, but it's still pretty cheap. And we'll go over, pretty expensive, but we'll go over that later. But the closing costs are lower. And they both come with a non-recourse guarantee, meaning the house goes down in value. The borrower is not responsible for a negative loan. In other words, if the loan balance exceeds the value of the house, the borrower is not responsible. The lender is, or FHA's trust fund is. And we'll get into that a little bit later. Again, it's called a non-recourse feature.
One more question. So say you have a 55-year-old and a 64-year-old that are married. Do they have the option to do the both of them, or they have to use one or the other?
What was the age of the spouse?
55 and 64. So one spouse is over 64, so that would be the FHA HECM. The other spouse is
Well,
55, so that would be the alternate?
Well, both spouses would have to be under the same loan, but in your example, they would be presented both products.
Which
And
one
we're
would be
always
better
going
for
to
them?
use, well, we're going to present both products to them, and both products, we're going to use the youngest person's age to determine how much the down payment's going to be. So you're saying a 64 and a 55?
Correct.
Okay, so we're going to use the age 55 to determine the benefits. Whether they do the FHA HECM or they do the proprietary portfolio
Okay.
loan, we're always going to use the youngest spouse's age when we do the calculation. So the math will probably be the same between both the FHA and the portfolio loan. In other words, the down payment's going to be the same. What's the difference? The closing costs will be lower on the proprietary, and the closing costs will be higher on the FHA, but the benefit to the borrower will be the same. The interest rate will be higher on the portfolio loan because it's not backed by the FHA, but they'll be given both options. And depending on what their goals are, there's with everything, there's pros and cons, right? I like to say
Yeah.
good, bad, and ugly. With everything in life, if something is so good, all right, what's the negative? And if something is negative, well, what's the positive? And I believe that it's important that customers understand the good, the bad, and the ugly on every loan. But absolutely, both loans would be offered to the customer. Here's the portfolio loan. Here's the good, the bad, and the ugly. And here's the FHA program. And here's the good, and the bad, and the ugly. And let the customer make the decision. And I can sit back and or defend or prosecute either product depending on which side of the fence I want to be on. Because again, I think there's pros and cons with everything you do in life, and these loans are no different. There's pros and cons in home ownership. Let me tell you a couple of cons. Who wants to be a homeowner when now all of a sudden all the maintenance on your house is your responsibility? And now you got to pay property taxes and homeowners insurance. As a renter, you don't have to pay that. If something breaks, you call the landlord, right? Or I could defend that and say, my gosh, the richest people in with exception of maybe the tech guys like Amazon and Microsoft and Tesla, where they made their money through tech. Rockefeller made his money through real estate. The railroad people made their money through real estate. Even Flagler, they made their. I mean, yeah, they were railroad tycoons, but they made their money through real estate. Real estate is what builds wealth in this country. So I can argue that side of the fence, right? If you want to be rich, get into real estate. But buying a home comes with responsibilities. Not everyone should be a homeowner, right? Fair enough. All right, let's get started. Oh, guess what? It's 10 till. Let's take a 10-minute break. What do you think? I have a question. Whoever wants to answer it. So, what interests you to come to this class today?
Didn't have the knowledge of what it is or how to help our clients, because here in Southwest Florida, we have a lot of people who pay cash only.
Good. Those
And
are
they
our
could take,
customers.
yeah, they could take that extra money and invest it in the stock market or wherever else they want to instead of putting it in home
That's right.
and not be penalized for it.
I had a person tell me one time that your home, your client's home, is going to increase or decrease in value, regardless if there's a mortgage or if it was paid for in cash, right? The house doesn't know that there's a mortgage attached to it. It's going to do what it's going to do based on the economy. And I thought that made a ton of sense. And Rockefeller even said, the way to wealth is to use other people's money. So why put all the money in your house that's not going to grow at all when you can put it in the stock market, or you could buy a rental property, or you could, use it to enhance your retirement life, enjoy it. And many times people will say, well, I don't want to be a burden to my children. I want to leave my house paid for to my children. But guess what? What are two kids going to do with one house? Right? They're
Yeah.
going to sell it.
Mm-hmm. Oh.
I had a customer one time. She didn't really understand how the fees work. We're going to go over fees later. And she was getting $60,000 more than what I told her she was going to get when we did the application. Her house appraised for a higher amount, so she was getting more money. She didn't want it. And I think, looking back, I think that she thought that she was being charged based on how much she was borrowing, not how much, FHA has their fees, but it's based on the value of the house, not how much you're borrowing. It's done differently than traditional financing. And she didn't want the 60,000. I explained to her the fees are the same, whether you take the money or not. And then I finally said to her, do you have children? I asked her a question. She said, yeah, I've got 3 daughters. Now she's 90, by the way. And I said, how are they doing? She said, well, they're struggling financially. And keep in mind, if she's 90, her daughters are 60s or 65, right? And they're always kids. They're always kids in the eyes of mom and dad. But I said, how are they doing? They said, oh, they could be doing better. I said, why don't you take the 60,000 and give them, it was this October, and I said, why don't you write them a check, give each one of them $20,000 for Christmas. Yeah, pretty cool story. She did.
Yeah.
Except it wasn't 20,000. She gave him 5. But still, it was funny. I saw her, after Christmas, and I said, "How was it?" She says, "It was the best Christmas ever. I gave them $5,000 each." And I was thinking, "Oh, what happened to the 20?" But she said it was the best Christmas ever. Go ahead, Layla. You're on mute. Still on mute. Don't you love these Zoom
Yeah,
things?
okay, now I can, yeah, sorry.
There we go.
I had a lot going on. I had a mover bringing piece of furniture, and my husband, of course, doesn't know how to handle these things. So the question is, I see this for somebody who is, an old person who has no children, and they don't have that much money, and they want, at least they can use the money from their home to live. For me, this would be a perfect solution for somebody who has no children and no inheritance, That's
Yeah.
where I can see this the best scenario for somebody like that.
Well, I think the poster child will be somebody who has no beneficiaries in the world, because there's absolutely no reason to save anything for anybody else if you have no one to give it to. But when it comes to seniors with kids, here's what I find. I've been in the retirement business for 35 years, and we're going to get started almost any time now. But let me answer this question, then we'll get back into the presentation. Here's the thing about ones with children. Usually there's more than one child. Usually there's 2 or 3. You can't take one asset and divide it up between 2 children without typically selling it. Number one. Number two is parents absolutely do not want to be a burden to their children in any way. So by having more cash in retirement helps them stay independent, which brings us to number 2, which mom and dad want to be independent. They don't want to be a burden to their children, and they don't want the children to be a burden to them. They want to be independent. And if they can help their children or grandchildren with a college education or to buy their first house, they want to do that. So there's a difference between inheritance money, which you could be blunt and say that's death money, or you could say it's love money. So I encourage people, first of all, the most important person on the planet is you, right? It's mom and dad. It's you. And the kids are second. They even say that when you're flying on a plane. If that oxygen mask comes out of the ceiling, put it on yourself first and then help your children. And the reason is because you can't help yourself, you can't help others. So number 1, take care of yourself. Number 2 is help your family. And by having cash in retirement, I'm not saying waste it, never ever waste money, because this is all you have in
Yeah.
retirement. Do a HECM. I believe that everyone that's 62 and above, 55 and above, should look into the program,
Definitely.
not necessarily do it, but look into the program and make a decision if this is something that would help them in retirement, help them be independent. And then help the children. Help the kids buy their first house. Help them with a $20,000 down payment. Help them get started in life. And they may be 40 years old when they're getting started in life, but it is what it is. But I believe that giving children some help as an adult before you die is love money. That's sort of how I look at, death money, inheritance. It's nice to always get an inheritance, but if they can be helped while they're alive, then you can have the best Christmas ever. So most of my clients feel the same way, and I do get some on occasion that's like, oh no, I want to leave my house. I want to leave my house paid for to my kids, and they're willing to eat beans out of a can in order to save that dime, that dollar. And I've got other clients that are taking those cruises, buying the Cadillacs, and then good for them too, right? All right, let's get started. So when your senior client says, "I want to pay cash for my house," dissect that. What are they really saying? They don't want a mortgage payment. No one really wants to pay all cash for a house, but no one wants a mortgage payment. And I think that's important to sort of understand that. Having cash and cash flow in retirement is absolutely king. Depleting a person's nest egg in order to eliminate a mortgage payment will, at the very last sentence, could spell disaster. I think it will spell disaster because money is king. And I meet so many people that something happened to their plumbing, something happened to their air conditioning in the middle of the summer. Their car broke down, transmission went out, and now they're having to put things on credit cards at 20, 30% interest. Having cash is extremely important in retirement. The number one fear of our retirees is not dying, is not even public speaking. You've heard that phrase before. I'd rather be given the eulogy. I'd rather be in the casket than given the eulogy. No, those are number two and number three. The number one fear of our retirees is running out of money. That's the biggest fear is living too long and running out of money. Number two is public speaking, and number three is dying. Interesting. All right. So the down payment for the HECM for home purchase, whether it's portfolio or the HECM, the FHA HECM, is somewhere between 60 and 70%, depending on a person's age. So the older they are, the less the down payment. The younger they are, the larger the down payment. A 55-year-old might have to put down 72% to purchase a home, but it gives them a boost in purchasing power. Someone wants to buy a $600,000 house, and now they're buying a $900,000, or potentially, if they wanted to, they could buy a $900,000 house. I like to use the word boost in purchasing power. 50% boost in purchasing power. When your client comes to you and says, "I've got cash money," and they look like they could be over 55, the question for them is not necessarily, "Are you paying?" You should ask them one of three questions. Are you planning on doing a HECM for home purchase, conventional financing, or paying all cash? Right? Ask them that question. Give them the three choices. Don't say cash or finance. Give them three choices. Are you planning? If they look like they're 60, 55 or over, go ahead and ask them the question. Will this be a HECM for home purchase, conventional financing, or all cash? And of course, they're going to say, "Well, what's a HECM?" It gives you the opportunity to explain it to them, because you're going to help them keep cash in their pocket. If they say, "Well, I've got enough cash to pay cash," and you take them shopping in the $600,000 neighborhood, and they're like, "Well, these are nice, but I really like the one across the street. Oh, that one's on the lake. Yeah, I like that. Well, that one's 800,000. Well, let's talk about it. Maybe there's a way." And then you're getting into the conversation. Now, you've just spent over an hour learning about this program, and I don't want you to be an expert. I want you to be excited about this program, but instead said, "Let me refer you to somebody who understands this. Let me refer you to a professional HECM specialist," and then just transfer them over. Your job is to sell homes. So let the expert explain this. If someone were to call me and say, "Hey, I want to look at that house across the street, thinking about buying it," I'm not going to take them over there and show them the house. I don't know the first thing about selling houses. I refer them over to you, right? So we need to do the same thing. So let me show you this. Our HECM Association, which is a 501c3 nonprofit real estate school, creates these flyers at no charge. So if you have a listing and you want to feature your house, this is something that we could do for you. It sort of explains the program. This focuses on the FHA, because the FHA is the safest loan in America. With bar none, it's the safest loan. So we like to focus on the FHA program. But if someone says, "Well, I'm only 58, my wife is 57, then we can talk about that too. The math is basically the same regardless of the program. But this sort of says it all. I'm going to leave this slide up for a little bit so you can sort of study it. It's going to come back later on, and if you want me to send this to you so you can see it, on your computer, I can do that too. But this is pretty cool, and this says it all. This $629,000 house, a person can purchase this house for about $410,000. That's a pretty sweet deal. This happens to be in the Villages, the world's largest retirement community, the Villages, Florida. Holy crap. All right, moving on. So the rhetorical question of the day, how many homes could you, Mr. Real Estate Professional, sell if all homes were discounted by 30% today and today only? If you had a list of a whole bunch of people who have cash that are looking to buy a house cash, and you called them up and said, today and today only, this again is just a rhetorical question, you can buy that house that you were looking at for 30% less than all cash. How many of those could you sell? And the answer is all of them, right? And that's how we have to look at this. All homes are on sale today by 30% less with no required mortgage payments. So the HECM for home purchase is a non-recourse loan. Again, portfolio or FHA, they're both non-recourse. So let's explain that. If something bad were to happen, if the house goes down in value, the mortgage balance exceeds the value of the house, right? It's possible. It happened in 2009, 10, 11, 12. Homes were upside down, whether it was traditional financing or the HECM. Homes went upside down. But with the HECM, if a person doesn't want to be responsible for the loan, including the family, including the estate, they can hand the keys back to the lender and walk away and owe nothing. Mom and dad pass away, the house is up underwater. There's a brand new Cadillac in the driveway, paid for. Bunch of furnishing inside the house. There's a 401k, there's CD money, there's a lawnmower, a riding lawnmower. There's lots of assets everywhere. Only the house is used as collateral for this loan, which means the kids could say, oh, it's underwater. Here's the keys, I'm walking away. No recourse, no estate taxes, no IRS taxes. The IRS isn't going to send a tax bill for the difference that was written off. It's non-recourse, no recourse. However you want to define that is, there's no recourse against the estate, not the children, not the family, not even mom and dad. If they decided to move back to Michigan and walk away from the house, even though they're still alive and kicking and they're driving their Cadillac up north, there's no recourse. Any questions? All right. Usually I get questions on that one. Well, this sounds too good to be true. Oh, it is true. So when is the HECM due? Is when the last borrower ceases to live in the property. They've died. They've moved into a nursing home permanently. They moved in with their daughter permanently. Then the loan comes due. And the lender will give them up to 12 months to settle the house, whether sell it, refinance it, whatever they want to do. When the last borrower or non-borrowing spouse sells or changes title, I'm sorry, when the last borrower or non-borrowing spouse leaves the house permanently, or if they sell or they change the title to the property, in other words, they give it to a stranger or to their kids, that happens with any mortgage. If you have a mortgage on a house and you change the title, the lender could call the loan due, and the HECM would do the same thing. So when the last remaining spouse or borrower passes away, it's sort of redundant there, fails to comply with any terms of the contract. In other words, if they don't pay their HOA dues, right, somebody's going to foreclose on that. If they don't pay their property taxes, their homeowner's insurance, the lender, any lender will say, well, that's part of the contract. So they've got to continue to pay those dues, those taxes. Any questions? All right.
So I have a question. So here, if the parents are going to nursing home and they owe this, they have the HECM loan in this house, and now the loan is more than value of the house, what happens?
So let me answer that in two different ways. If mom and or dad, let's say they both get into a car accident, they're both going to a nursing home for rehab, and let's say they're there for months and months and months, 6 months, 8 months, 9 months, 10 months, but they're planning on coming home. The loan is not due. But if they're gone and they know they're not coming home, then the loan comes due and they're given 12 months to settle the estate. But now to answer your question, let's say it's determined at that time that the amount that's owed exceeds the value of the house. And let's say that the kids don't want the house anyway, because most kids don't, believe it or not. They want the money, they don't want the house. But let's just say that no one wants the house. Mom and dad are done with the house, either because they moved away or they moved into a nursing home. They're just done with the house. If it's determined at any time when no one wants the house that it's underwater, they can hand the keys and walk. They can do a deed in lieu of foreclosure and walk away, and there's no black mark on their credit report. There's no taxes due. There's no judgments against them. It's truly a non-recourse loan. Now, let me throw a wrench in the works. Let's say it's underwater and the kids do want the house. It's on the beach. It's a mile from Walt Disney World, right? They want the house. They've always, maybe it was a family house. Maybe these are Floridians. They were born and raised in this house. Maybe they do want the house, but it's underwater. The kids can get the house at 95% of what the current value is. They can get the house for less than fair market value. Now they've got to refinance it. They got to pay cash. They got to somehow eliminate the debt. But let me put that into dollar amount so we can focus it. And if you want to write this down, sometimes it's better to see it in black and white. Let's say what's owed on the house is $600,000. Mom and dad did this HECM loan 15 years ago. Interest has accumulated, and now what's owed is $600,000. And let's just say that we're in the middle of a housing recession, and the house is only worth $500,000. All right, so it's underwater by $100,000, and the kids want the house, or maybe the neighbor wants the house. Heck, doesn't even have to be the kids. Maybe the neighbor wants the house, but no one's going to give $600,000 for a house that's only worth $500,000. So whoever buys this house can get a clear title for 95 cents on the dollar. So what is that? $475,000. They can get clear title. The lender will eat the difference, because that's what the non-recourse feature does. The lender eats the difference. Now, if it's the FHA HECM, then FHA eats the difference using the trust fund, which I'm going to explain that in a couple slides. So the taxpayers aren't responsible is what it comes down to. There's a trust fund. When it comes to portfolio loans, there's money set aside for that. There's no insurance fees, but there's money set aside for these non-recourse insurance bailouts. Is that good, Layla?
Yeah, but so what is it for the bank then, who giving this loan? So if it is this kind of loss, or
Yeah.
like,
So
how
so
does
they
the bank make his money this way?
Yeah, so the interest rates on the portfolio loans are more in the 9% range, where the FHA is more than 6.5%. So they're making enough money to offset losses. So they don't charge an insurance fee. FHA charges an insurance fee. It's a half a point a year. So there's a trust fund building up. Well, the lenders just charge about 2.5% more in interest rate, but they're easier to qualify for. They'll do the uninsured or non-FHA approved condos. They'll do properties that FHA won't touch. So again, with every product, there's good, bad, and there's ugly, and that's why I think it's always important to give your borrowers, your buyers, their choices. Here's the proprietary loans. Here's the good and the bad. Here's the FHA loan. Here's the good and the bad. And I'm a big fan of both of them. So I think everyone that's 62 and above, 55 and above should look into these, because I believe them. I believe these are amazing programs. Okay, questions? Good. Whoops, I think I went the wrong way, didn't I? Let's try this again. There's again. There we go. All right. So for the FHA program, I'll fix this so where it actually says FHA, but I was doing this just for the FHA, not even talking about portfolio loans. But portfolio loans have gotten so popular that now I'm including them in this presentation more so than I ever have before. So for the FHA, HECM, all borrowers must be 62. However, spouses are actually not considered borrowers. They're considered non-borrowing spouses, but they're still part of the loan. They still have the same protections. They could be age 18 plus. And as crazy as that sounds, I did have a customer. Well, he actually didn't do the loan, but he inquired anyways. It's a fascinating story. He was 72 and his wife was 25. Oops, raised me. Okay, let me come back to you, Catherine. Um, so he was 72 and he was married to a 25-year-old. True story. And he had a condo in Tampa. And the story goes, I think it's fascinating. He went down to Dominican Republic on vacation and he fell in love with a 22-year-old, I think. And she didn't speak any English and he didn't speak any Spanish. And he was white and she was black. It just makes it for a better story. True though. And they fell in love. And to this day, they were married for like 3 years. They still don't speak each other's language, but they love each other. And he wanted to take care of her. So he was asking, can I do this loan? And I've never done one with a 23-year-old. So the amount of money that he could get, his condo was paid for. The amount of money he was going to get was not much. It was like, I don't know, 35,000 or something. It was not a lot. But she could live there the rest of her life without any mortgage payments. He could get some cash now, have no required payments, and she could stay there the rest of her life. Now, if she's 20, 25, she could live another 50 years, 60 years. No required mortgage payments forever. Interesting story. So for the FHA, there's no credit score required, but credit does matter. When it comes to the portfolio loans, they do have a credit score. Depending on the company, it's anywhere from 620 to 680 or better. But they're more interested in the credit payment history than they are the score. So we don't have automated underwriting like traditional financing does. We actually pull their credit reporting, look at things line by line. We also look at their payment history for their property taxes, homeowners insurance, and HOA, where a lot of times the Ford mortgage company doesn't even look at the HOA payments or the homeowners insurance payments. We do. Because there's no required monthly mortgage payments, we look at things that could affect the loan. If a person doesn't pay their property taxes, they could lose their house. Fair enough? If they don't pay their HOA, they could lose their house. So FHA in particular, and so does the portfolios, they look into, okay, if there's no mortgage payments, are you still going to pay your obligations, homeowners insurance, HOA? And if they have not paid those things on time in the last 2 years, then there's questions. Now, I'm not saying we're going to deny the loan. I'm saying there's questions. Why did you not pay your property taxes or your homeowner's insurance? Well, because my car broke down and I need the money to fix the car. Okay, well, that's a life event. Could have happened to anybody. So we can potentially forgive that. But if they just said, well, I forgot, that's not really a good answer. We need something better than that. And then we've got to prove it. So our underwriting is different, is the whole point. We can do this for anybody with a Social Security number. So if they're not, as long as they have the right to live in this country and they have a tax ID number, they can do this loan. They do not have to be a U.S. citizen. And that's important because sometimes we have somebody who's married to a non-U.S. citizen, or maybe the two people are in this country for years but never got their citizenship. That's okay. We can do their loan. Okay, so the question's already been brought up. Can we do this on any property? The answer is yes. Pretty much any property we can do this on, but it's got to be their primary home. Now, there is some portfolio companies that'll do it on second homes. So if you have somebody who wants this on a second home, it can't be a rental property. It's got to be like a vacation property. They have a beach house. They have a house in the mountains in Tennessee, but it's got to be their second home. So townhomes, villa, cluster homes, modular, manufactured, new construction, and we can do the loan while the house is under construction, but we can't close on it until the CO is issued. So that's got to be done before we can actually close. Quadplexes, triplexes, duplexes are fine. Condominiums are fine. FHA is tough to do condos, but portfolio loans kick in nicely. So the house has to be move-in ready. During the housing recession, we had a lot of fixer-uppers, and FHA won't do fixer-uppers. It's got to be move-in ready. I had a house that was missing a shower head. Guess what? It's got to be fixed. If it's a purchase, it's got to be fixed. It's a shower head. I get that. It's $10. Go to Target and get a shower head for $15. Now, guess what? It's got to be fixed before closing. No fixer-uppers. And again, manufactured homes, they must be built 1976 or newer. They can be in a park. They can be out on their own land. They can be on leased land. As long as they're at least single wide of size, 400 square feet, Now think about how small 400 square feet is. That's more like a construction trailer. And again, leased land is okay on as long as the lease is worded properly. They are tough to do, but as long as it's worded properly. And FHA doesn't prefer them, but they're doable. All right, down payment money. I've had people that want to go out and borrow money for their down payment, and FHA won't allow it. You cannot borrow money to borrow money. They don't want you to have a mortgage payment in addition to a HECM. So it's got to be your own money. I had a guy who sold his gold bars. I kid you not, but he could prove that he bought the gold bars 3 years earlier, and of course, he had a receipt when he sold them. So we used gold bars. I had a person who wanted to borrow money from the 401k. Nope, you got to cash it out. You cannot borrow money to borrow money. But whether it's an IRA, 401k, stocks, bonds, you can get money from your whole life policy. If you want to sell a car, I had a guy who sold his car, but he had a receipt from PayPal. He had an asset. He sold his car. He had a receipt that he owned the asset. He sold it. It's fine. Anytime you go out and borrow money, so I've had people that say they want to buy a house in Florida, so they go out and get a second mortgage or even a first mortgage on their home in Maryland. They use that money for the down payment to buy the home in Florida. That's allowed as long as the money has been seasoned for 2 months in the bank account. So you can borrow money to borrow money as long as you season it. If they sold a house somewhere else and now have cash, and 2 days after they sold the house, they want to use this cash to buy a house, that's okay because they had the asset, they sold the asset. It's not like they borrowed money. So the key thing to remember is you can't borrow money to do a HECM. However, with our program, you can get gifts from friends or family. That's pretty cool. With traditional financing, you can't get a gift money from a friend. And I had a customer who bought a house in the Villages who got a gift from one of his best friends going back 35 years. He got $50,000 from his friend. Gift from his friend. That's pretty good friendship. But with that, he was able to get a house. Questions? All right. So
I have a
what is
quick
not allowed?
question. I have a
All right,
quick
go ahead.
question.
ahead.
On deed purposes, if the loan it's only in one person's name or both parties named on the deed,
Yeah. So
ownership.
when we close on the loan, anybody who's not part of the HECM cannot be on the deed. So I'm doing a loan right now for a sister or a lady who is on the deed. Let me make it more complicated because it's a true story, so it's easy to follow. I have a customer right now. There's 2 sisters and a brother. The brother just died. One sister's on the deed and the deceased brother's on the deed, but the other sister is not on the deed. Okay, so we'll make this complicated, but it's a true story. So brother just died, he's on the deed. Sister's on the deed. Now she's the sole owner, if you will, but she wants her sister to be on the reverse, the HECM with her. So at closing, we're going to add the other sister to the title. They're both going to apply for the loan. In fact, we've sent the loan application out last night. So both of them are applying for the HECM. The brother's going to be taken off at closing with the death certificate. We're going to take them off at closing, add the sister, and when we close on this in 30 or so days, the 2 sisters will be co-owners of the house on the HECM.
But if only one of the people's names is on the HECM, then the ownership is only in that one person's name.
So anybody that's on title has to be on the
Part
loan.
one. Okay,
Right. So if let's just change the storyline. The 2 sisters are on title now, but one of the sisters does not want to be part of the loan. At closing, we would take the sister off. Oops,
right, got it.
wrong finger. Yeah.
That's okay.
Now
I got it.
the sister both sisters can live there, but
But only
the
one gets
title,
actual ownership.
yeah,
Okay,
the title and the mortgage have to be the same.
have to be the same. Okay.
Yep. Okay. So things that are not allowed for funding sources. They cannot go out and get a mortgage on a second home unless they season it. So if they're going to do that, first of all, we're going to know about it because it's going to show up on the credit report. But as long as they put the money in their bank account and season it for 2 months before we start the HECM application, they can use money from another home. And that's why there's asterisks in all of this. You cannot borrow money from anybody, but you can get gifts. You can't get money from a second home unless you season it. You can't do any kind of subordinate financing. In other words, you can't go out and get a first-time home buyer. Well, that's the next one. Personal loans or advances. I've had people put their earnest money on a credit card. Well, guess what? That's an advance. You can't do it. And we can fix it, of course. We just pay back the credit card and use money from your checking your savings. You can't get loans against anything, not the 401k. You can't get a loan against your life insurance. You can cash out your life insurance. You can cash out your 401k. You just can't borrow against it. Everything's got to be seasoned for 2 months. All right, we have 20 or 30 minutes left, so let me keep moving here. So what does it cost to get into this? So for the FHA program, the appraisal is typically about $600, $625. If it's a big house, it might be a $700 appraisal. If it's a super big house, it might be a $1,500 appraisal. HUD counseling. Whether it's HUD counseling or proprietary counseling, the cost for a 30-minute counseling session is about $150, and it's required to do this loan. FHA came up with a rule 30 years ago, and the proprietary loans followed suit. So it's really just a safeguard, just to make sure, since we're dealing with the elderly, they want to make sure that since it's a protected class, that there's a neutral third party getting involved to make sure somebody's not taking advantage of somebody. And then the FHA loan costs. Now, one of the disadvantages, one of the biggest complaints that I get is the closing costs are high with the FHA product. Not so much the proprietary, they're actually pretty low. But the FHA HECM closing costs, I like to break into 3 categories. First of all, the FHA insurance fee, right? The FHA insurance fee is 2% of the appraised value. So if you're dealing with $1 million property, and look at the very bottom where it says 1,209,000, that's a lending limit. That's a pretty cool number. We'll get into that next. But let's just say we're doing a $1 million home using an FHA HECM. FHA is going to charge a one-time fee of 2% of the appraised value. That's a $20,000 fee to guarantee this whole non-recourse part of this loan. The lender is going to charge a $6,000 fee, call it points if you will, and that's to make sure the interest rate is as low as possible, because the lower the interest rate, the more we're allowed to lend. So now we're at $26,000 and we still have third-party fees, title insurance, doc stamps, intangible tax, all the stuff to go with mortgages. And those fees are going to probably be about $10,000, maybe $15,000 in third-party fees. So now we're at $40,000 in closing costs. Now, it's $1 million house, okay? So $40,000 in closing costs is not really that outrageous, especially when you throw in the real estate fees on top of that if it's a purchase. We are allowed to do seller concessions. That's important. And someone could say, well, $40,000, that's outrageous. Well, guess what? It's non-recourse, and there's no required mortgage payments on $1 million property. And when you put that into perspective, it's not so bad. If someone doesn't like the closing cost, then we have the portfolio. The portfolio loan eliminates most of the $6,000 origination fee and all of the FHA fee. So closing cost drops from $40,000 all the way down to maybe 15 or 20. All right, well, the interest rate's higher, but the closing costs are lower. The FHA Pro is disadvantage is the closing costs are higher, but the interest rates are lower. So this is where we would sit down with the customer and figure out what's in their best interest. And we would do an amortization going over time and looking at the true cost of any loan. Not having a mortgage payment for the rest of your life is worth tens of thousands of dollars, if not hundreds of thousands of dollars of cash that stays in the checkbook. All right. Any questions before we jump into this? We good? We good. All right. I'm going to go over this relatively fast. This will interest some of you and it will bore others. So I'm just going to go over this semi-fast. We can always slow down. So let's talk about what financial planners thinks about this kind of a program. So there's 2 ways of thinking. There's some financial planners that are focused on younger people that work on wealth creation, right? Let's not spend any money. Let's just build wealth. But it gets to the point where it's more about maintaining what you have. When you're into the retirement years, it's more about hanging on. So maybe when you're in your 20s or 30s or 40s, maybe you're investing money in high risk investments, knowing that what goes down goes back up over time. But once you retire, what goes down may not go back up in time. CFPs, certified financial planners, are really excited about the lack of required monthly mortgage payments. Whether you have kids or no kids, they like the fact that it's about the cash flow for a couple of reasons. One, it's in the client's best interest, but it's in their best interest as a financial planner to be able to maintain their assets because they get paid a percentage of the money that they're maintaining. And if it grows, great, but it's more about hanging on. When a financial planner does what they call a Monte Carlo scenario, they want to make sure that this amount of money is going to last a person to their age 95. So what can we do? And they Monte Carlo is a software program that says, well, what if? What if one of the spouses dies when they're 65? What if bond prices rates go up or down? What if interest rates go up or down? What if we hit a recession? What if stock market crashes? What if? What if one of them needs long-term care? What if, right? And there's 10,000 different scenarios on what could happen. And they want to make sure that their assets are going to last. And the only way to make assets last to age 95, maintaining a current lifestyle, is to include home equity. I'm not saying everyone's going to go out and do a HECM. What I'm saying is that home equity has to be part of that plan, or almost for certain the plan won't last to age 95. Now the question is, do they go out and do a HECM now and let the line of credit grow at 7%, which we haven't discussed yet, but I will, or do they pull or do they pull the money out and invest it, or do they consider that to be an option 10 years down the road? There's all those scenarios go into there, and only a financial planner can make that educated decision by doing some kind of a Monte Carlo scenario. The other thing is to realize that when a person goes out and gets a mortgage, the first 10 years of a person's 30-year mortgage is interest only payments. If you ever look at the amortization schedule, the first 10 years, if your mortgage payment is $2,000 a month, chances are for the first couple of years, $1,950 of that $2,000 is interest. The rest is principal, which means nothing. And as it gets up to the 10 years, it's still mostly interest. And once you get past the 10 years, then you'll start seeing that the money starts getting into more principal, where it actually starts paying down the loan. When you get to 15 years, then most of it is principal. Maybe of the $2,000 payment, maybe $1,100 is principal and $900 is interest. It is until the last payment, where almost all of it is going to principal and very little going to interest. So it's interesting when someone says, well, I really want to pay down my mortgage. Well, if they're 70 years old getting a 30-year mortgage, until they're 80, they're still paying mostly interest. And that interest is not refundable. You'll never see it again. It's gone. So do you want to send that interest to the bank, or do you want to leave it in your checking account? Whether you have kids or no kids, do you want that money to go to the bank that you'll never see again, or do you want to leave it in your checkbook? Your kids want the cash. They don't want the house. They want the cash. So keep the cash in your bank account and let the kids inherit the cash, and they can do what they want to with the house. Again, I'm going to go through this relatively quick. Let's talk about Social Security. I think most of us know that you can get Social Security as early as age 62. But if you can hang on and not draw Social Security until you're 67, which is full retirement age, you'll get a bigger paycheck. Your Social Security check is bigger at age 67 than it would be at age 62. You get an average of an 8% annual pay raise every year that you can delay Social Security. The problem with delaying Social Security is that, well, you're not getting Social Security. The problem with drawing Social Security is if you're still working, the IRS will tax you upwards of 50%. Yeah, you heard me right, 50. 50% of your Social Security check could be taxed. There's rules. There's how much you can allowed to earn, things like that. But if you make too much, you're going to lose upwards of 50% of your Social Security. So if you're still working, you're probably better off to delay it or work part-time so you don't exceed that amount of money. If you can hold off on drawing Social Security, until you're 73, sorry about that. Oh, shoot. if you can hold off to your 73, you can actually maximize 8% a year for an additional 9 years. Now, the problem with waiting till you're 73 is, well, what if you died at 67? Right? What if you live to 73, you're all Social Security, and you die at 74? So, right or wrong, I don't know. But one thing I do know is that a person can do a HECM at 62 or 55 for the proprietary one and delay Social Security. And the money that comes from a HECM is not taxable. So you could say to the HECM, send me $1,000 a month. I don't even want the lump sum. Just give me $1,000 a month. I'm going to continue to work. I'm going to delay Social Security. And then when I turn 67, then I'm going to draw Social Security and I'm going to start paying back my HECM. Or maybe I won't. The point of this is that this is a way to do financial planning. This is a way to include the HECM as a financial planning tool to maximize your cash flow income in retirement. And this is where a financial planner truly gets involved. Let's do the Monte Carlo scenario. Let's figure it out. I want to continue to work because I'm only 62 and I see the advantage in working. Or I want to retire because I'm 62, but I need the money, right? So let's talk about it. Okay. So additional financial planners' thoughts. So not having a mortgage payment in retirement gives options, right? To spend or not to spend, to save the money for the kids or not save the money, to take that big vacation or not. A husband or boyfriend, girlfriend, one of my employees did a HECM loan for a boyfriend, girlfriend. They had their own house, and their boyfriend, girlfriend, they're seniors. They didn't want to move in together, at least not now, but they maintained their own house. They both did a HECM, and they both went on a 120-day cruise together. Now, is that a dream vacation? I'm not saying it was money well spent. And then again, will I do it? I don't know, maybe. But isn't that the dream of a lifetime if you like cruising and you don't mind being gone for 4 months? I think it's pretty cool. It's a good story. So if the U.S. has another housing crisis, one disadvantage of buying a house all cash, because what if we have another housing crisis and a $500,000 house is now worth $250,000? And if you don't think that's true, then you didn't live through 2008, 2009, right? Homes went down in value a lot. There was a story, true story, one of my clients, actually one of my employees' clients, but still, this was 2009. And this guy, I think he's 78. It's been a number of years, so I have to remember all the details. But the guy's 78 years old. And my employee called me and said, is there an asset limit on can a person who's rich do a HECM? And I said, yeah. And we do HECMs on $10 million houses, $5 million houses. So there's no asset limit. He said, I know the answer to that, but I have a customer. He's loaded. I said, well, what's his house worth? He says $275,000. This is a true story. I said, really? He's rich? Yeah, he's got 15 million in the bank. I said, well, why would he do a HECM on a $275,000 house if he's got $15 million in the bank? I said, where did he get his money, by the way? I'm curious. Apparently he owned a hotel or a couple of hotels. He had sold them. He had all this money. I said, well, why would he do a HECM? He says, because he thinks we're in a housing, maybe it was 2006, actually. He says, because he thinks we're in a housing bubble and it's going to pop. And I said, well, I don't know if it's going to pop, but yeah, I think it is. But he says, well, he's really smart. And if it pops, he wants to go ahead and extract all the money from his house in case it pops. Because if it pops, then he's going to have more money than the house is worth. I said, well, that's true. And if it doesn't pop, then he can just pay the loan back. Oh, okay. I mean, the guy was smart. He figured out the system before the housing crisis hit. So he did the loan. And sure enough, as we all know, probably this $275,000 house dropped down to $150,000. But based on his age, based on the amount of money we could borrow at the time, the guy probably borrowed $200,000 back then. Now the loan's not quite as generous. But the guy was smart. He cashed out, and guess what? He got to live in the house the rest of his life with no required mortgage payments. And he's got $200,000 he can invest outside of his house. And as his house goes back up in value, he wins both directions. Again, that's where the non-recourse loan kicks in. All right. So what's next?
I have a quick
So
question.
yeah, please do.
I think you had already said it, but I didn't write it down, because I am taking notes, but what is the maximum dollar amount that you can mortgage for this, for a
Right,
HECM?
yeah, I touched base on it earlier and I
Right,
didn't finish up.
I
So
just
thanks.
didn't write down the amount.
Yeah, so I'm glad you asked the question again. The FHA lending limit, and I want to be careful when I'm going to explain this in a moment. The FHA limit is $1,209,000. $1,209,000 and $750. 1,209,750. Now
Okay,
that doesn't mean that FHA will allow us to lend that much. What that means is that's what they're going to cap the value of the property.
okay,
Then the person's this age with a $1.5 million house that FHA caps at 1.2 million, and then they figure out how much they're willing to lend. So how much they're willing to lend might be $500,000. For FHA on a $1.2 million house, the FHA cap based on a $1.2 million house, because that's what they're capping it at, might be $500,000. However, this is where the proprietary loan kicks in. If you've got a customer who has a $2 million house, a 1.5, 2 million, a 5 million, a 10 million, a $15 million house, the FHA is not the product, right? We go back to the proprietary HECM because they will look at the entire value of the house, the whole 15 million, based on their age, come up with a number. And that number might be $5 million that they can cash out. And you think rich people don't need or want HECMs? Remember what Rockefeller said, you get rich by using other people's money. Sometimes rich people do an investment and it doesn't work out for them. Sometimes their expenses are so high, their property taxes are $100,000 a year because they live in a multi-million-dollar house. They drive the really nice car because they always have. They always take the best cruise suite on the cruise line because they can. They eat the caviar because they can. The difference between the average person and a rich person is the size of the problems, right? They don't have a $10,000 problem. They have a $200,000 problem, right? It's the
mhm,
size. So many loans are done for very wealthy people, and this is definitely not the loan of last resort. This is the loan that fits. And when you're dealing with multi-million-dollar houses, it's not unusual for them to be paying 9% interest on their jumbo loans. It's what they do. Using extracting money from a primary home, $1 million, $2 million allows them to go buy some other rental properties to create wealth and to create income. So I've had people say, "Oh no, all my clients have millions of dollars. They would never do this." Oh no, they would. You're being naive. We do multi-million-dollar loans all the time. All right, I'm going too fast. All right, so going back to this, what is your responsibility? Your job is just basically identifying the home buying senior that is 55 plus. We'll pre-qualify them. We'll get them counseled. We'll verify their income, credit. We'll issue a pre-approval letter. Your job is to take them shopping. Your job is to allow us to explain the program to them, run their credit, do the proposals. Your job is to get the purchase contract. It's really that simple. So we'll do all this. We'll verify the credit, income, their assets. When it comes to residual, we do not have a debt to income ratio. Most forward mortgages are 40, 42% of their income cannot be for housing. In our world, if their income was $10,000 a month, but their expenses were $9,000 a month, all their expenses combined came up to $9,000 a month. There's not a lender out on the planet that will loan them any money to buy a house. In our world, we will. A married couple only needs $886 a month outside of what shows up in their credit report and property taxes to be able to be qualified for this loan. In other words, do you have enough money for groceries? After we pay your property taxes, your HOA, your homeowner's insurance, and anything that shows up in your credit report, is there enough money to buy groceries and to pay your internet bill and your cell phone? And if you're married, 886 is what you have to have left over. Again, a $10,000 income needs no more than $9,000 in expenses per month. If you're single, they need $529 left over for groceries. They cannot be delinquent on federal income tax, including student loans. And you think that seniors don't have student loans? Yes, they do. Either they have student loans because they co-sign for the kids or grandkids, or they have student loans because they decided to go back to college. and then sometimes they default on them. So they cannot owe the IRS or any kind of government agency any money. And if they do, then they either have to be on a payment plan or they have to satisfy that debt. And so the word is delinquent there. Be careful on that. The word is delinquent. If they're on a payment plan, we're fine. That means they're responsible enough to get a payment plan. They have a student loan, they have 15 years to pay it. That's fine. But if they're delinquent, then they either have to pay off that debt at closing or set up a payment plan before closing. So your job is a sales contract. We'll get them pre-approved. If we can get some seller concessions, that would be pretty awesome, up to 6%, but we don't have to. It makes it a little bit easier to swallow if there's seller concessions, but then again, that's your job. We do not have the same thing as traditional financing does. This product is even different than the FHA loans. When you think if you happen to be an FHA loan expert because you do a lot of FHA financing, well, just clear it out of your mind, because in our world, yes, we fall under HUD, yes, we fall under FHA, but we have a different set of rules. For example, $1.2 million is our lending limit, where traditional FHA financing is, I think, 500,000 or something. I don't do regular loans, so I don't know. But it's a lot less. So we have a whole different set of rules. We don't have TRID. We don't use the settlement disclosure. We use the HUD 1. Remember those days? We still use the HUD 1. We have a whole different set of rules. So it truly is an expert. You should never do a HECM loan with any loan officer unless they specialize in HECMs. Unless they specialize, stay away from them. All right, we have a whole bunch of people we can refer you to that can help you, that are experienced with HECMs. But just because if you call up your favorite mortgage guy and say, do you do reverse mortgages? And they say yes, ask them more questions. When's the last time you did one? How often do you do them? If they don't do them every month, then don't do business. This is your customer. The last thing you want to do is lose your customer because your loan officer doesn't know what they're doing. And you also don't want to have your closing not close on time. We do have some extra forms, FHA mandatory clause, real estate certification forms. That's if it's FHA. We don't have to have a home inspection, but it's always good to have one. It's contingency. And move it on. Any changes? Easy. Do we do an addendum? We do them all the time. Easy. This is just a fun fact to know. 55, 62 all day long. But if you look at the 1.2 million people that have completed a HECM over the years, for some reason, the average age is 72. I've had people say, well, seniors don't buy houses. Oh my gosh, yes, they do. Some say that every 5 to 7 years people move, which is true. It doesn't matter if you're 80 years old. Every 5 or 7 years, sometimes they move. Up in the villages, the average a person moves in at 62-ish, right? They retire, they move to the villages. A lot of millionaires in the villages. Lots and lots of them. They buy and sell 2.5 times. They're 62. By the time they're 82, they've already sold 2.5 times more and moved across the street, moved to a different neighborhood. And this is in the villages. They don't even leave the village. They just move to a different village. So seniors do buy houses. And I've had people say, well, all my customers pay cash. I don't need this program. All my customers pay cash. Well, hopefully I've shown you why those are the customers that we need. I've had people call me and say, I want to do a HECM. And I've got $10,000 down payment. It's not my customer, right? They need 65% of the purchase price in order to do this loan. So we're looking for cash buyers. And then what we can do with the cash buyers is either help them keep money in their bank account for retirement or help them buy a nicer home if it makes financial sense for them. So can a senior purchase a home valued at over $1 million? And the answer is yes. Yes, they can. 1.209,750 is the 2025 limit. 2026 will be higher than that. And again, that's the lending limit, not how much the FHA is willing to lend. That's the lending limit. So maybe out of that, they're willing to lend $500,000. On the portfolio loans, it's pretty much unlimited. $15 million, $20 million purchase, it's whatever. And then one more time, portfolio loans come into play even on low value homes because FHA doesn't do them all. They don't like condos. They'll do condos. FHA doesn't necessarily like leased land, but they'll do leased land. They don't necessarily like manufactured homes, but they'll do manufactured homes. The FHA has specific homes, and most of the time the FHA HECM is the product of choice, but sometimes it's not. And when it's not, it's either because it's a unique property, such as a condo, or it's a expensive home, such as more than 1.2 million. All right. So marketing, you sell what you talk about. If you never talk about the HECM, then you'll never sell one. So one of the things you can do to get the conversation started, I'm a big fan of getting the conversation started. One thing you can do is bring it up from the very beginning. Will you be buying this house cash, conventional financing, or a HECM for home purchase? Right? Get the conversation started just by name dropping it. Get the conversation started by having a flyer in your open houses that explains that you can buy this house for less than full cash price. And here's some senior demographics. I'm going to go relatively quick because we're about 5 minutes from the top of the hour, and I want to end on time. There's actually 13,000 baby boomers turning 62 every single day in this country. And I jokingly say they all moved to Florida, but somewhat that's true. There's a lot of people moving to Florida. Florida is, well, it says on the third bullet. So there's currently over 1,000 people a day moving to Florida every day, all ages, or 30-year-olds too, but 1,000 people moving to Florida every single day. 24% of the home buying population in Florida are 62 plus. 35% of all the homes that were sold last year in Florida, 35% were sold to people 62 plus. I've had realtors tell me I don't sell to seniors. Well, you're missing 1 out of 3 buyers. 24% of the population is 62 plus. 35% of all home sales were sold to seniors. You're missing the boat. $17 trillion of the nation's wealth, 72% is controlled by seniors. Many people are cash buyers. Why? Because seniors are wealthy. 40% of the population are 60 plus are planning on moving, jokingly, to Florida in retirement. 86% of the seniors want to age in their own home. So they're living in a 2-story house. They need to move into a 1-story house because that's aging in place. 96% of all the seniors who have completed a HECM are completely satisfied, according to AARP. 96% of people that do HECMs, now they understand them. They've gone from I hate a reverse to I like reverses to I love reverses. So why should you target the senior market? Referrals. Seniors talk to seniors. Seniors socialize with seniors. Baby boomers are relocating, and the HECM for home purchase is changing the way seniors are buying homes. So one more time, patio homes, condos, townhomes, manufactured homes, duplexes. Here's something that's beautiful we haven't even talked about yet. A person can purchase a quadplex, a triplex with a HECM. They can use a HECM to purchase all the plexes, live in one and rent out the others, have no required mortgage payments. Think about that. They have $500,000 cash money. They go buy a triplex. They rent out the other 2 units for $2,000 a month. They have all this income and no mortgage payments. And they live in one of the units for free. Single home, duplex, triplex, quadplex.
That's insane.
It's absolutely insane. Now talk about cash flow. Talk about building wealth in retirement. So you are now the informed real estate professional. According to NAR, 99% of real estate agents do not understand this program, which means now that you do, you take this and run with it. You go to the builders, you go to this 55 plus communities, you can own that community because chances are the real estate agent that owns the 55 plus community doesn't understand this program. And if they do, they're not promoting it. You take this by the horns and you will be the top senior professional in your whole area. Advertise homes for one large down payment and no monthly mortgage payments ever will increase your volume. Again, seniors talk to seniors, referrals. Get more listings by using the HECM tools. In other words, most real estate agents don't understand the HECM for home purchase. 35% of the people that I will show your house are going to be in the 62 range, which means they might be able to afford this house and they wouldn't be able to afford them otherwise without the HECM. As your new listing agent, if you give me the listing, I can offer your house to more people and get top dollar for it. So use this as a tool. So we just talked about rental properties. And we're moving on because we're out of time, but I'm going to give you all these slides. I'll give you this video, anybody who wants it. I don't like the word downsize, by the way. I like the word right size, because just because you move to Florida, it doesn't mean you're getting a smaller home. Maybe you are getting a smaller home, but it's a more expensive home. Maybe you're getting that 55 plus community, the swimming pool on the lake, right? So I like to use the word right size. Many times it's truly a downsize, moving from a 3,000 square foot home to a 2,000 square foot home. But I like calling it right size because it's right for them. They're going from a 2-story house to a 1-story house that's on a golf club community, right? It's right sizing their retirement life. And this is what I said before, always do what's best for your client, always. If a VA loan is a better deal than a HECM, run with it. If an FHA loan is better, run with it. If paying all cash, conventional mortgage, a jumbo loan, if a first-time home buyer program. By the way, first-time home buyer is a misnomer. It just means they cannot be a homeowner for the last 3 years. How's that a first-time home buyer? I don't know. But if they've not been a homeowner in the last 3 years, a first-time home buyer might be the way to go. USDA financing, and of course, cash. And I told you the story earlier about a lady who gave a bunch of money to her kids for Christmas. You know, it's about building legacy. I call it love money. Build their legacy while they're alive. Help their children purchase a home, buy long-term care insurance, buy a new car, pay off debt. You know, don't be a burden to your children. Get yourself debt-free. You know, have everything, pay cash for everything, take vacations, take your grandkids on vacation, enjoy the world. Helping our seniors. Helping our seniors just feels great. Quality of life should never decrease with age, right? Helping someone have a better life, the last 30 years of their lives, is just makes someone feel good. And most of all is because you care. So, and I'm out of time, but real quick, our HECM Association offers CE classes on other subjects. So this one is pretty much talking about the HECM for home purchase. You know, I like to use the word 50% boost in purchasing power. You can buy a $7.5 million home for $5 million cash. You know, 50% of $5 million cash gives you an extra $2.5 million to buy a nicer home. We're going to skip all this. Apparently I talk too much. Okay. So we have government loan program, talks about USDA, FHA, VA. We have the portfolio, which is a whole presentation in itself. I mixed the two together today. And then there's our company information. So that's my email address. Lisa, I'm the president of the HECM Association. Been in the business 25 years, been in the retirement business 35 years. I'm a certified senior advisor. I'm certified reverse mortgage professional, certified HECM specialist. I've got the credentials. I know what I'm doing. Very good at what I'm doing, if I can brag on myself. And if you want my direct number, if you've got a pen, it's 321, or you can email me and I can send it to you, 321-356-9229. And that number gets me to 321-356-9229. My name is Tim Linger. Tim Linger at HECM Association also gets to me. All right, so officially we're over. Anybody want to have any questions?